All right, my friends, I'm going to share with you, I just want to quote from Stocks from the Long Run book by Jeremy Siegel. This is the 5th edition. I'll put a link to the show notes. If you're interested in markets, not just stock market, but just the history of the market, you just got to buy this book. There's no other reason. There's no other way around that. I'm going to refer to this quite a bit going forward. Every now and again, I'll just pick a piece off here that is of interest to me. The one I want to share with you here today is about small caps and the small cap value premium in particular. For some reason, this has been it just hit me again for a ton of bricks for some reason. A good friend of mine was telling me that he was going to invest all his money in small cap value stocks because small cap value stocks have outperformed everything else historically since, again, the modern era of investing, 1926. And I hear that a lot. I've actually succumbed to it before myself. I mean, inherently it makes sense. If you can survive as a small cap, i.e. don't go bankrupt, there's a pretty good chance that you're going to not only survive, but you'll grow to a big cap. So if you can buy Microsoft as a small cap, and then it just advances as it grows to a big cap, you're going to be wealthy person. And we know about the Microsoft millionaire, from the janitors to secretaries to you name it. We've heard that a million times a Sunday. And what I love about Siegel is just so much in here that's almost counterintuitive, because that makes sense. Small caps, they're also riskier, all right? So riskier means more reward, and the whole litany of stuff goes on. And then if you look at the track record of small caps, we do see a significant outperformance. But I want to share with you what we talk about here. This is on page 176. Now, we use French. Siegel talks a lot about French Fama, and if you're not familiar with dimensional fund advisors or French Fama, you really need to be for sure. But I'm going to read it verbatim. I'm going to read you page 176 about small and large cap stocks. Cracks in the CAPM, the capital asset pricing model. Oh, for the love of me. Black-Scholes capital asset pricing model. What's the efficient frontier? I mean, all this stuff is just, all right. But anyway, cracks in the CAPM capital asset pricing model's predictions of stock returns appeared well before Fama and French's research. In 1981, Rolf Banz, a graduate student at the University of Chicago, investigated the returns on stocks using the database that had previously been compiled by the Center for Research and Security Prices, located at the University of Chicago. And that's the CRSP, Center for Research and Security Prices. I think, if I'm not mistaken, Vanguard got rid of the Wilshire 5000. I think they went to CRSP a while ago. Don't quote me on that, but it's in my head that they did. That's from the University of Chicago. So Rolf Bonds found that small caps systematically outperform large stocks even after adjusting for risk as defined within the framework of the capital asset pricing model. To analyze this claim, the returns from 1926 through 2012 on 10 groups of more than 4,000 stocks sorted by market cap are shown in this table right here, which I'll share with you. I'm not going to see the whole thing because it'll bore you. The compounded annual return of the smallest decile of stock at 17.03% was more than 9.5 percentage points over what would have been predicted by the capital asset pricing model. The return of the second smallest decile of stocks at 12.77% was more than 3.5 percentage points above it. And what you'll see here is they're breaking down the 10 deciles of the smallest to largest market capitalization of stocks. And I mean, the total market averaged 9.67 as a geometric return. The arithmetic was 11.59. The smallest decile, so you take 100 stocks, the 100 smallest, or the 10 smallest, averaged 17.03. I mean, basically, that's almost a doubling. And that's going back to 1926. Now, here's the kicker. Although the historical return of small stocks has outpaced large stocks, the magnitude of the small cap stock outperformance has waxed and waned unpredictably over those 86 years. Again, 1926 to 2012. A comparison of the cumulative returns of small caps with those of the S&P 500 is shown on figure 12.1, and they show it right here. And again, it's going to be tough to see. But that light line is a small, this lighter, so you can see way up there relative to the S&P 500. Again, you have to get the book to really see that. All right, but here's where it gets interesting. Small stocks, measured from the bottom quintile of market capitalization, recovered smartly from their beating during the Great Depression, but their performance only matched large stocks from 1926 to 1960. Even by the end of 1974, the average annual compound return on small stocks exceeded that of large stocks by only 0.5% per year, not nearly enough to compensate most investors for the extra risk or trading cost. But between 1975 and 1983, small stocks exploded. During these years, small stocks averaged a 35.3% compounding annual return, more than double the 15.7% on large stocks. Cumulative return in small stocks during these 9 years exceeded 1,400%, my friends. Nevertheless, if the 9-year period from 1975 to 1983 is eliminated, the total accumulation in large stocks over the entire period from 1926 through 2006 is virtually the same as small. Eliminate the years from 1975 to 1983, and there is no small cap value premium. There is not, or premium. What caused the tremendous performance of small stocks from that period? In the late 1970s and early 80s, pension and institutional managers found themselves attracted to smaller stocks following the collapse of the large growth stocks known as the Nifty 50. In addition, the enactment of the ERISA, the Employment Retirement Income and Securities Act in 1974, made it far easier for pension funds to diversify into small stocks, boosting their holdings of these issues. After 1983, small stocks hit a long dry period that lasted 17 years as they underperformed large stocks, especially in the late 90s as a tech bubble gained momentum. But when the technology bubble burst, small stocks strongly outperformed once again. From March 2000 through the peak through 2012, despite the severe intervening bear market, small stocks enjoyed a 7.2% annual return, while large stocks by the S&P 500 returned less than 1 percentage point a year. Whatever the reasons for the small cap surges, the trendiness of small stock returns does not seem to mean that investors should avoid these firms. Small and mid-cap stocks constitute about 20% of the market of all U.S. stocks, and one should be warned, however, that the existence of the small cap premium does not mean small caps will outperform large stocks every year or even every decade. Small caps, yes, they have outperformed, or at least they did as of 2012. I bet not now. I don't know. I just really don't care. But I imagine not now, because the last 5 years have been wonderful for the S&P 500. In 2015, the small Russell 2000 got hammered. It was in a full-fledged bear market, and the S&P 500 was not. So my presumption is there has been a large cap premium over the last, he's talking since 2006. I bet there's been a large cap premium over the last 10 to 12 years. I don't know that, but again, the idea that small cap stocks have outperformed large cap stocks going back to the modern era of investing, and taking that, which is true, at least going back to 2012, and taking that and predicating that on your decision to outweigh for small cap stocks, you would have to say, well, what causes small cap stocks outperformance? And the cause of that was, frankly, what Siegel was saying. ERISA was passed in 1974, and lo and behold, 1975 to 1983, small cap stocks take out like a bat out of hell. Is there some coincidence there? Probably. Is there some correlation, cause for cause, whatever it is? Yeah, absolutely. I'm 100%, I'm convinced that's the case. Does that mean there won't be something like that in the future? I don't know. But with that said, I know people say, I'm going to go to small caps because they outperform large caps historically, or I'm going to do this because they outperform that. I frankly don't care. You can do whatever you want to do, but what is the underlying reasoning for these things? And the same thing as Siegel talks about, the 1966 to 1982, the S&P 500 did nothing. They might have been saying the Dow. I mean, some of these naysayers, the S&P did nothing in 1966 to 1982. That's just simply not true, not when you factor in dividends reinvested. There's always an underlying theory or thing to these premises that people fall on. And I'm not saying it's a fallacy. It wasn't a fallacy that small caps outperformed. That is true. But if you take away those 7 years there from 1975 to 1988 years, 83, there is no small cap premium. And so you shouldn't make the bulk of your investing based on that alone. You just should not, especially when you look at things like the capital asset pricing model. It's just all that stuff, just silly. Again, because we're trying to make a science, a hard math, with the investors that are out there each and every day. The companies you invest in. I just went right now to try to get my wife a Christmas present, a Bath and Beyond Body Works or whatever it's called, Bath and Beyond, Bed and Body, I don't know where, some store. It was closed. Didn't open until noon on Sunday. Stupid. Last Sunday before Christmas, not open until noon. Dumb. So I did not buy something there. Instead, I went across the road and bought something out from a different store instead. How is that reflected in the CAPM? How is that reflected in Black-Scholes option strategies? I mean, it's just all this stuff is silly. I mean, at the end of the day, Bath and Body Works, or whatever that store is called, there's two, Bed Bath and Beyond and Bath and Body Works, I think. The Bath and Body Works store was closed, and they turned away a customer. It had nothing to do with what the economists say or the analysts, or it has something to do with my behavior as a consumer. And without that good purchase that I would have made, you compound that by many, many, many people. I don't know what that effect is on the bottom line. But the fact that some human being decided we're not going to open our store until noon could have a significant impact on the way that company's numbers look and the way that stock will perform as well. Simply because they forgot to open the doors earlier on the last Sunday for Christmas. How do you account for that in your stock analyst? I just simply don't know, which is why you really can't. All right. Anyway, so get the book. Again, I don't know which. I'll put the most recent edition on my on the thing here. And again, if you buy through my link on Amazon, I get a commission of probably, I think this one's 4%. It's a big book. I mean, it's literally, in my opinion, a Bible of investing. 400 odd pages. It's your resources. I mean, there's so much stuff in here. I'll put a link to it. You should buy it for sure. I turned to a page, Efficient Frontier. Oh, I hate that stuff. But anyway, I'll put this out there. I hope you find this informative. We'll see you next time. Thanks, guys.